think I really appreciate you mentioning that everything, most risk assets, even gold, Bitcoin, cryptos, stock market are the most linked by most measures in history, partly because the stock market is so extremely expensive. Now we're up 15%, almost total return now is approaching 18% on the year. That's the third year in a row after the COVID issue. And people are just accustomed to that. It's all priced in every model. It's just assumed. And gold's telling you better stop assuming that. And to me, that's what's happening. And now even gold's too expensive. So what you pointed out, I think, is just the aberrations of history. You get to late stage cycles in bull markets. Now, that's certainly been the case in cryptos. The Bloomberg Galaxy Crypto Index is up only about... It's classic signs of peak bull market, very similar to Bitcoin reaching 100,000 last year is gold reaching $4,000 this year. Just to point out, as we speak, it's right at $4,000 an ounce on October 27th, and it's up 52.5% on the year. So there's some factual statements are just plain scary. Now, the last 100 years, gold's within it's the fourth best year ever, followed by 1979, 72, and 73, all massively inflationary periods. What's happening in gold this year is, I was using the term scary before, but now as we approach Halloween in this country, I want to use the term frightening, because it's never rallied at this velocity without at least a decent pickup in stock market volatility and significant, most notably either deflation or inflation. So I'm worried about the signals it's telling us, and I'm heeding them. And I think that's part of the reason I think gold is pretty much peaked near this level, at least for now. You don't want to buy a raging bull market as they pile on. It's getting the pile on trade, and versus virtually every single moving average. We can go the 40, 50, 60 month, 200 day, 100 day. It's the fourth or fifth standard deviation, as people might say. I just say it's the highest since like 1981. And we do get stretched like this, but it's always there's always, sometimes the bell rings, and if you've been overweight and you've been a strategist like me saying buy it forever, which I had to get beat up for quite a while, we can remember those days from 2000 to 2023. McGlone was bullish, and I just got thrown down the mat. But when it finally gives you that, you're supposed to take something, and now I'm just afraid of what it signals for the rest of the market. I mean, versus virtually every risk asset on the planet, even on not a risk-adjusted basis, underperforming the rock is not a good sign.
What are you? So you're afraid of what it signals. What does it signal?
It signals to me the potential. Well, my interpretation is this type of rally in gold. And when we look back from the future, will have told us, yeah, it was finally time for a little bit of stock market volatility pickup in U.S., which is still running near multi-year lows on a 90-day basis. Maybe a little bit of backup in the extraordinary wealth creation in this country that's been, it's most in history. And that's not just stock market cap GDP, it's U.S. stock market cap versus the rest of the world, housing, almost everything. And then, of course, the one thing that gold loves the most is obviously geopolitics, the Russians' invasion of Ukraine being supported by China, according to NATO, and Mr. Trump. Gold loves Mr. Trump, pushing back in the Fed, telling how he's going to make the world great by doing things that made America great by reversing some of those things. So the thing is it going to get any better for gold? And that was what I nailed, and not so much nailed, but picked out in Bitcoin last year. Once it reached 100,000, I thought it was just everything piled on for the best it's going to get, and it's been lagging since. And that's what I'm looking at for gold right now. But bottom line is it's so stretched now that it can either drop easily back a third, which would be around 3,500, and to go from here to 5,000 anytime soon would be, I'm already pointing out how historically stretched it is now, would just be unprecedented. So there's simple lesson as a money manager. I got my FRM in 2006, I think. That stands for Financial Risk Manager. Never really use it.
Gold has never pushed upward with this velocity without major stress building elsewhere, either high inflation, sharp deflation, or a spike in market volatility. Yet today, volatility remains unusually calm. Measured across key long-term price averages, gold now sits multiple standard deviations above trend, stretched further than any time since 1981, right at the tail end of a massive bull cycle. Professional risk managers describe such moves as unsustainable, often preceding painful reversals. When traders begin piling into a trade just because it's winning, history warns the party is nearly over.
The most, well, it's very much unprecedented. And the only comparable high velocity move in gold in history, we had a big, similar in 2008 to 2013, is basically late 70s to the peak in 1980, 1979. Those are only historical, but they're not comparable for many reasons. So basically, you have to sometimes switch off why you've gone to a certain level and switch off my risk management hat. And that's what because there's always a reason. And that's when I switch over. Okay, so in the past, it's got this stretch or did this or meant that. And that's what I point out, as you just pointed that article I showed, is you virtually never get rallies in gold, sustainable rallies from these type of stretched extremes. So just say right now, it's still about 90% above its 60-month moving average. That's most since 1981, actually, and that was near the peak. And so to do that, it needs further fuel. So the number one source of fuel, I think, right now is just a potential pickup in U.S. stock market volatility, 90-day volatility recently, just this month, bottom at the lowest level since 2020. Now that's up a little bit, but it's curtailed. And then you look for other reasons, but from these type of levels, also we're in the midst of a shutdown. There's a lot of reasons for it to be putting in a peak, just the way I think Bitcoin somewhat peaked and put major signs of a late-stage bull market when it reached 100,000. Now it's still higher, but since then, gold has taken off. That was since December last year. Gold has taken off. Now it's getting expensive, and to me, that's why everything I looked at is like alternatives to the stock market getting expensive are gone, and that's why I tilt over. To me, the next big trade might be deflation from the inflation, which is all the lessons of history show that. Certainly, that's the case in China right now, and I can pause there and go wherever you want.
So, what is this rally signaling? Gold tends to surge when the world begins preparing for unpleasant financial surprises. U.S. stock valuations sit near record highs versus global peers. Household wealth is unprecedented. Meanwhile, geopolitical tensions, Russia's war in Ukraine, rising friction between U.S. and China, polarized political leadership continue to escalate uncertainty. Gold is effectively saying something doesn't add up. If volatility returns to normal historical levels, stocks could re-rate lower, and wealth built over the last decade would suddenly look fragile. Gold's explosion is not celebration. It's a warning siren.
I really appreciate you mentioning that. Everything, most risk assets, even gold, Bitcoin, cryptos, stock market, are the most linked by most measures in history, partly because the stock market is so extremely expensive. Now we're up 15%, almost total return now is approaching 18% on the year. That's the third year in a row after the COVID issue. And people are just accustomed to that. It's all priced in every model. It's just assumed. And gold's telling you better stop assuming that. And to me, that's what's happening. And now even gold's too expensive. So what you pointed out, I think, is just the aberrations of history. You get to late stage cycles in bull markets. Now, that's certainly been the case in cryptos. The Bloomberg Galaxy Crypto Index is up only about 12% this year, with the S&P 500 up 18%. So it's way underperforming. Bitcoin's up only about 23%. It should be up 40 to 50% with a year with the S&P 500 up that much. And gold's leading everything. So is that just a feint from gold? We'll have to see. But I look at the macro indication, bigger picture. At the same time this is happening, bond yields in this country are declining. Right now, we're 3.99 in the U.S., 10-year note yield. The 30-year is 4.57. So these bond yields are declining. That's not because of inflation. They can't go down in inflation. They go up. At the same time, we're seeing things like crude oil collapsing down 14% in the year. And here's a statement that I'll make that's never happened. For a while there, at least now, gold's up 52%, crude oil's down 15%. That's about almost 70%, 65%. That's the most in history. We've had that kind of disparity between the most significant global commodity, crude oil, and the most significant historical store value. Now, most recent example was 2008. Now that marked the end. To me, this might be marking the beginning. So obviously, I'm still sticking with this bias that at some point, this is an indication the stock market's going to start giving back or having a normal correction, which means probably 50%. I've been wrong, but I wasn't wrong on gold. And that's what I'm really concerned. Now, you can't just buy gold here. It's too expensive. What's left? So I'll point out what's left. The last few years, I've been pointing out, I've been very bullish gold, very bullish cryptos. I stopped being bullish cryptos and Bitcoin last year and tilted over to gold. That so far has worked well. Now I'm tilting over to one less thing that's left, and that's deflation from the inflation and U.S. Treasury bonds.
gold could certainly continue upward, but the risk of retracement is rising fast. Analysts estimate a 30% pullback is well within precedent, potentially dragging prices back toward $3,500 without shocking anyone. At the same time, pushing higher to $5,000 would require explosive new fuel, major inflation resurgence, or a severe market meltdown. Central banks are indeed stockpiling gold at a modern-era record pace, yet even that buying cannot offset gravity forever. At these heights, every additional dollar higher must be justified by global fear growing larger than ever.
So the gold-silver ratio bottomed at 80, and the peak this year, just 80 recently. 80's been good support for over a year. It got a little bit below that. You show 78, but that happened right about the time that stock market volatility started bottoming. Now that it's picked up a little bit, at least in the 60-day, and it's bottomed and going higher. The key thing to remember about gold-silver ratio, it's historically has never really settled above, recent was 105. It's never really settled much above 90 on an end-of-the-year basis. So it's at historic levels. And this measure can go back 1,000 years. And relevant data, at least 300 years. It's a pretty good indication. And one thing that's more significant every day is because gold is becoming more of a store of value and central banks are back to buying it. And there you go. How far you go
I've
back?
never noticed that before. It's, this is a kind of a noisy chart. We have to smooth it out, but it does look like there's kind of a rolling relationship here between the VIX and the gold silver ratio. It's interesting.
So the VIX recently looked, it bottomed in 14% in, guess what, August, of course. And it just peaked recently around 23%. Now it's back down at 16%. Can it stay lower? The 200-day moving average is 19.3, and it's been heading higher since Trump got elected. But the bottom line is the gold-silver ratio is ticking higher, and I think it's going to continue higher, partly because stock market volatility is so low. But what you see on that VIX right at 16 is it is still almost 2 times realized volatility. 90-day volatility is running 10%. Recently, just reached the highest spread between the VIX, which is implied, and realized 90-day at like 2.1 times in the highest in 13 years. So the extremes I'm mentioning are happening in an environment of complete complacency in the stock market. And what I'm expecting is maybe we're going to look back from this future and say those are the warnings. But gold silver has been a great indicator. It bottomed at around 80. It's not right now at 85. It's first good resistance. And unfortunately, I think it's still going to head higher, particularly if stock market volatility continues to pick up. And right now at 16% VIX, that's kind of not exciting for gold silver.
While gold rockets upward, oil prices are falling and bond yields are declining, a combination that historically appears when economies are slowing. The gap between gold's gains and crude oil's losses is the widest on record. Bitcoin, typically a high beta risk asset, is underperforming despite strong equity markets. Another oddity. When assets that normally rise together begin diverging sharply, it often marks a late cycle turning point. Investors who once hid from inflation are now bracing for the opposite threat, deflation, especially visible today in China's weakening economy.
No, 25. 50 would be a bit of a shocker. They're going to cut 25 now and 25 at the next meeting, and they're going to go down to 3% at this time next year. The key question is, that's all priced in. That's expected. That's the fuel. If we don't get it, there's a problem. The key question is, what might it take to accelerate that process? The number one thing would be the stock market going down. Now, here's a key thing that people have learned from people like Marty Schweig and everything. Don't fight the Fed. But there's an issue with sometimes the Fed just started an easing cycle. There's an issue when you're not supposed to fight the Fed, and people have been doing it for 30 years, and all that works. And we're at the highest stock market valuations ever, and everybody does the same thing. What Benjamin Disraeli said, what we generally anticipate does not occur. I remember distinctly when the Fed started cutting rates in 2001, the first business day of the year. From that level, the S&P 500 dropped about 50%. When the Fed first started cutting rates in September of 2007, from that level, stock market initially went up and then dropped about 50%. I think it might be similar now, and it's all going to be led by cryptos. But we're near now, as you mentioned. We've had this somewhat of a détente with U.S.-China trade issues. The Fed's going to ease. Everything's wonderful. My point is, gold seems to be disputing that a little bit, and you better count on that. So that's why I'm just putting together my outlook for industrial metals for November. And I just point out industrial metals will be fine as long as the stock market goes up. Cryptos will be fine as long as the stock market goes up. And there's your problem. But as we speak, even with the stock market going up, bond yields are still ticking lower, crude oil still ticking lower. Some of these key indications are showing that there's a problem. So look at it this way. We're up almost 20% in the year. Just imagine if it gave back 10% of that. Crude oil probably dropped to 40. Bond yields at 4% might drop to 3.5%. See how we're dependent now upon this massive wealth creation in the U.S. that reached the highest ever? And that's what I think gold's figuring out.
The Federal Reserve is preparing to cut interest rates, a move many assume will keep the boom alive. But rate cut cycles in 2001 and 2007 began just before stock markets fell nearly 50%. When optimism becomes automatic, when gains are simply expected, that's when markets are most fragile. Gold's message is unmistakable. Wealth creation has reached unsustainable heights. A normal correction in stocks, falling real yields, and deflationary pressures would force investors back to fundamentals. Gold, having led the warning, may soon step aside, leaving the rest of the market to face reality.